And we're back. You're listening to IBGR, the International Business Growth Radio Network. My name is William Eastman. I am host for today's show. This is a show or podcast. What do you need to know and how to play the curve? What are we talking about? We're talking about business cycles, the economy, and how do you get on top of what's going on right now so you can better equip yourself for what is next. We had a couple shows over the last 18 months on this topic. We called Debt Economics for Business Owners, and we're just now trying to fool around with the title to make it sexier. So this is the new world of business economy, Neo World as we call it, or Neo Econ. Neo Business Econ. Yeah, I think that's where we're going to go. All right. Anyway, let's not get tangential. Let's get to the topic. We're in segment or podcast number 3. So you need to go to the website, ibgr.network. That's IBGR, International Business Growth Radio.network. Our URL, our name, and our broadcast frequency. When you get there, you see resources off to the right. Mouse over, that is a pull-down menu. Click show notes, and when you get to show note page, about 2,400 pages of them, if you're there early, or you're there somewhat close to this live broadcast, you will see show 2, what do you need to know to play the curve? Click it. If not, then right next to whatever's listed there, you'll see new choice of business search. Put that in there. Show 2, what do you need to know, and play the curve, and then you got it. Now, once you're there, let's scroll down to segment 3. All right. Now, in the first segment, what we did is we talked about basically the business cycle itself: expansion, boom, recession, depression, okay? Or recovery, positive bubble, cleansing, negative bubble. Then last one we did was we took it a little bit further and said, how do I read whether or not we're in expansion or contraction? So we looked at price and supply, demand, and price. We looked at producer price index. We looked at consumer price index. We looked at the availability of credit and employment or unemployment as a trailing indicator. If you haven't heard those, you got to go there. Now, today, this segment right now, this period of time that you and I are spending together, is we're going to talk about inflection points and bubbles and really kind of end it for this whole thing. And in our first show last week, we did 4 segments on economics. So basically in 7 segments, 7 12-minute segments, we're covered the landscape, okay? So what's an inflection point? Well, it's nothing more than a point in time when there's a transition between one state or another. In other words, if you're expanding and now you're contracting, that's an inflection point. Or it could have to do with price and demand and supply, which is a place I'm going to go to. Essential knowledge if you have stocks, okay? Because what you want to know is you want to know not whether or not there is a bubble. There always will be a positive or negative bubble in the market. The question is where are we in the bubble and what causes that? And we're gonna talk about that here. So during expansion, there are 2 inflection points. All right. The first is signaling the trough here between the waves is the signaling that the contraction is over. Right? It's over. It's over. It's over. So if we go back to what we were talking about before, in this particular case, let's take producer price index and consumer price index, PPI and CPI. PPI shifts from negative or neutral or negative to positive, while consumer price index is still negative. In other words, what's happening here is the producers who are doing far more market research than consumers can see that there's a light at the end of the tunnel, which is not the oncoming train. So they're beginning to gear up because the deal here is going to be the raw materials, whatever it is that you need in order to produce what it is you sell, are never going to be cheaper. Your competitors, because of the contraction, are seriously damaged or gone. And this is going to be a time when who is willing to take the risk to be first is going to make the most money. And so I am looking really close at what they're doing right now because, again, this is not research that I have to do. This is research of me watching the key players and trusting that they understand what they're doing. And when I put it together, because I don't trust any singular data point, what I do trust is the collection of that. And so those are the 2 inflection points for an expansion. In a contraction, it's the crest, okay, and the beginning of the negative bubble. And what I mean by negative bubble or positive bubble is that the bubbles are not based on rationality. This is where emotion comes in, and this is, I talked about it in last week's show throughout this, and why my particular economic model that I use, and I'm self-trained, so I'm not going to tell you that I got a degree in it. I don't. I've self-taught myself, is I'm an Austrian when it comes to economic models. Not has anything to do with Austria, though the originators of this were Austrians, but that's kind of it, and it's certainly not how Austria is currently doing business. But the Austrian model works on the premise that the economy is based and driven by emotion and people's perception of what is real. Not necessarily what's real, but the perception of what's real, as opposed to things like, say, socialism or monetary theory or fascism or Keynesian economics, any of those other schools, which are all based upon the fact that economies operate rationally. They do not, okay? I don't think you have to be around a long period of time to understand that. And so what a bubble is when the emotion really begins to take over, and it's more emotion than it is reality. So, for example, a positive bubble, which we're going to get into right here, is when the value of something, what it's really worth, the price that you could charge greatly exceeds its value because everybody wants it, okay? As opposed to a negative bubble, and that's an emotional issue. A negative bubble is exactly the opposite when it isn't worth. You can't even break even. It's not even worth what it costs you to make it. So let's go through this, all right? So let's take a look at inflection points and bubbles. When you're at the bottom of the trough and you see the wave coming on and we're going to start the expansion, here is the deal. The value of what this is truly worth is far greater than the price you can command in the marketplace. Why? Because there is no demand for it. And so if you are lucky, is that you are breaking even on the sale of that product or service. More than likely, in order to move it, you're going to have to run a sale and you're going to lose money on it. So understand that in this first quarter, so visualize this. You're in the trough, and halfway up the wave, we're talking about this sector. And in this sector is the value of what you're selling, is the price of what you can charge is far less than the value of it. Yeah, I know value is subjective, but just go with the flow. All right, and then you get at a midpoint here in the wave, and that's when price and value equal. In other words, there's more and more demand for what you have, and then suddenly you're making about what should be right for that particular product or service. All right, so for example, if your estimation is we should be making a 40% margin on that's probably about right, then you're making about a 40% margin. Now, when price becomes greater than value, where we are now is we are in the middle of a positive bubble. And the positive bubble starts the second where price, what you can charge, is greater than the value. It's like going down and trying to buy a car right now, and because of chips, you can't. A lot of manufacturers can't get chips, so their cars are not there. And what happens? They're putting a market adjustment on the damn car. All right, and it could be a couple $1,000s. Why? Because they can. That's what I'm talking about here. And this is the start of the positive bubble, is that suddenly everybody's clamoring for it. The demand is there. Everybody gets excited about it, and now they're bidding up the price. And what that says to you, if you are in that market, make more. If you're not in that market, but you have the ability to do that, it says get in. And so suddenly what's happening is there is a flood of supply coming in because what they're doing is they're reading the price increase. Now, of course, you know how this ends because it ends this way all the time. Now, suddenly, we're at the top of the crest, and this is an inflection point because at some point in time, the price will you can no longer hold that price. At some point, you're going to exhaust the demand for whatever it is that you made. And then suddenly, you've got new players in the market who may or may not know what they're doing. You've got but you definitely have excess supply, and suddenly you can't move the stuff. And it's almost like overnight you go from, we can't make this fast enough, we can't keep it on the shelves, to, what the hell happened? Nobody's buying it. And that is a clear indicator that the expansion is exhausted. Okay? The bubble will convey to you that the expansion is exhausted, and the contraction is about to start. This means the bubble has burst. You know, they're talking about it right now on the stock market. How much higher can it go? Now, I can't tell you how much higher it's going to go. I don't play the stock market other than I watch it. But I can also tell you is that how many bad days have they had, and they've had no corrections. Now, so the question is going to be on the stock market, is there a correction out there and then it's going to continue to go up? Or is there going to be a correction and it begins to go down? I can't tell you, but I can tell you where I would come from on this, and that is I wouldn't bet on it. I wouldn't bet on the next downturn is just a correction. All right, so now what's happening here is as we're going down to contraction, all right, so you got to where the bubble burst, we're going down to contraction, and what's happening is the price is going down because the demand is going down. And so what we're doing is whatever supply we got, we're basically selling. Well, at some point on the backside of the wave, the next inflection point is we've come back to kind of stasis between price and value. Now, if it stayed here, would be wonderful. It doesn't. And now we're into the beginning of the negative bubble, is that now people are so distressed by the downturn that they're negative on everything, and now these really start pounding, and suddenly you find yourself in a situation where, hell, you can't get a margin on it. You can't even sell it at break even. In order to move it, you might have to have a discount, and that is when that's the negative bubble that is going to have to burst, and when it does burst, that's when the next expansion starts. Now, if you play along with me right here, you can see that if you understand that and you understand where you are in the cycles, what business decisions would you make? Now, when we come back from the break, I am not going to go into those decisions. I'm going to talk about where would I look to get some of this information. But next week's show, oh yeah, we're going there, and we're going to take each piece of the cycle and we're going to talk about what is the right move. And I've been doing this for years, and it's advice I've given other companies. So I feel comfortable sharing it with you. Okay, so with that, you listen to William Eastman on IBGR. This is What You Need to Know.